Have you ever thought about how and where insurance companies get revenues from? If you have that doubt in your mind, let's get to know about it. We probably know what insurance is and what an insurance company is. They get revenue mainly from two basic ways. One is underwriting income, and the other one is investment income, or sometimes both ways simultaneously. Let's learn more about it. Do you actually receive the promised returns from a life insurance plan? One of the largest financial agreements a person will ever sign in their lifetime is a life insurance policy. Knowing where your money is going is crucial. The truth is that insurance firms know a fairly organized process to make sure that the premiums they receive are invested and grow over time, providing customers with the desired benefit. Premiums are one of the primary sources of revenue for an insurance company. By the way, what is a premium in insurance? It is the cash that people or businesses have paid to obtain insurance coverage. Insurance companies rely on the insurance premium when securing coverage for all liabilities connected to the policy. In order to generate returns and pay for part of the costs associated with the coverage, the insurance company may also invest the premium in securities. Depending on the conditions of the insurance policy, these payments may be paid annually, semi-annually, quarterly, or monthly. What do insurers do with the frequently sizable amounts of money they receive in premium payments? The insurance industry makes a lot of money from all of those premium payments. The businesses are not required to give any money until an insurance claim is made. To guarantee that they would have enough money to cover any claims anticipated in the near future, the businesses set aside some in reverse. However, they invest the remaining funds after that. Investment income often represents a much smaller portion of underwriting income. Many insurance companies make reasonably cautious investments, possibly buying bonds or dependable blue chip stocks. Apart from collecting premiums, insurance firms can still greatly boost their top and bottom lines through their investments, and they also make a sizable profit from their investments. Insurance companies also get revenue through underwriting income. But what is an underwriting income? The profit made by an insurer's underwriting activities over time is known as underwriting income. The difference between the insurer's receipt of insurance policy premiums and its subsequent expenses and claim payments is known as underwriting revenue. An insurance policy is a contract in which the policyholder and the insurance company agree to periodical payments from the policyholder in exchange for the insurance company bearing the financial risk of specific events. The term premiums refers to the consistent payments paid by the policyholder. A loss event is an exact occurrence that the insurance must pay for. A claim is a payment paid by the insurance provider should the loss event occur. The coverage term is the time frame between the beginning of insurance and its expiration. The insurance company can forecast future loss events and, consequently, the approximate amount they may have to pay out in claims with a given level of certainty using previous data and statistical analysis. Actuaries are employed by insurance firms to model the timing, likelihood, and cost of potential claims. The analysis also determines the cost of insurance premiums. The loss ratio is a proportion of premiums to claims. In such situations, insurance underwriting is essential. Without sound underwriting, the insurance provider would overcharge some clients while undercharging others for assuming risk. In a way, insurance claims are the genuine product of an insurer. The business must process claims from customers, verify their accuracy, and submit payment. This adjustment procedure is required to weed out fictitious claims and lower the company's risk of suffering a loss. An insurance premium is paid to an insurance company when it issues an insurance policy for a new customer or renews a policy for an existing customer. This is how they are paid. The expenses incurred by an insurance company include both routine operating expenses and money distributed to customers who submit insurance claims for accidents or other similar occurrences. Let's assume that the insurance company receives $1 million in premium payments for its policies. It might save the money in a savings account or have it on hand, but both are less practical options. At the very least, the risk of inflation will apply to those funds. The company may decide to put its money in safe short-term assets instead. As a result, while it waits for prospective benefits, the business earns additional interest money. Items in this category that are frequently found include treasury bonds, corporate bonds with a AAA rating, and an interest-bearing cash equivalent. Reassurance itself defines something, isn't it? Reassurance is protection for insurance providers. It's a method of shifting some of the monetary risks that insurance firms take on while providing coverage for persons, properties, businesses, and automobiles to a different organization, the reinsurer. What justifies reinsurance for insurance companies? Reinsurance is frequently obtained by insurers for a variety of purposes, such as increasing an insurance company's capacity, stabilizing its underwriting outcomes, financing, acquiring disaster protection, etc. For instance, based on models that indicate the minimal likelihood of a storm affecting a geographic area, an insurance company may write excessive amounts of hurricane insurance. If the unthinkable occurred and a hurricane did strike that area, the insurance firm might suffer huge damages. Insurance firms might run out of business every time a natural disaster strikes if reinsurance doesn't take some of the risks off the table. Unless it is reinsured, regulators rule that an insurance firm can only offer a policy with a cap of 10% of its value. Reinsurance enables insurance companies to transfer risks, enabling them to be more aggressive in capturing market share. Reinsurance also smooths out insurance firms' normal swings, which can result in considerable variations in earnings and losses. In many ways, it resembles arbitrage for insurance companies. They charge more for insurance to individual customers, but the prices drop when they insure their policies in large quantities. Beyond decorations and investments, insurance companies may also charge service freight for policy administration, policy changes, and other affiliated services. This freight adds to their overall profit. Piecemeal from the normal profit income, insurance companies try to attract further guests by furnishing ancillary services. What are ancillary services? Health services, known as ancillary services, are those that aren't given by a croaker but are nevertheless covered by insurance. These services support a croaker's opinion and course of care. But how does doing this help the insurance company? It is, of course, the draw. Consumers with whole life insurance plans frequently want the plurocrat. Indeed, if it means cancelling the account when they learn their thousands of bones in cash values. With full understanding that all obligation for the insurer ends when a client withdraws financial value and closes the account, insurance companies are only too eager to misbehave. Why do consumers neglect to modernise their insurance? Consumers each too constantly neglect to modernise their insurance content, which results in a profitable script for the insurance provider. A policy lapse, as defined by the insurance policy contract, occurs when the factual policy ends without any claims being settled. In that case, insurance enterprises make plutocrats again, since the insurer keeps all preliminary paid decorations from the consumer with no chance of a claim being paid. That is another plutocrat making occasion for insurers, which let guests assume all of the threats associated with maintaining a policy and walk down with the cash if they either outlast the content period or fall before any of the decoration payments. Insurance enterprises have really manipulated the system in their favour, and as a result, they continue to benefit. According to Asudity statistics, only 3 of every 100 insurance guests who pay their periodic decorations file a claim. Insurance enterprises take all of those ultra-expensive payments and invest in the plurocrats in the meantime, which helps them make further plurocrats. Insurance enterprises have a clear path to profit since the playing field is heavily disposed of in their favour, and they follow that road every day to the bank. For hundreds of times, it has been a formula for fiscal success, and it still will be in the future. The typical insurance consumer has no choice but to continue paying their rates and cross their fritters. Hope this video helped you to update your general knowledge. If you liked the video, put a thumbs up and hit the subscribe button to support us. Comment your thoughts below in the comment box.